Now, this is Michael Douville, and it is March 31st, 2021. What an interesting world we find ourselves in. I'm a baby boomer. I can look back and see uh, my life has just been amazing. And I've watched history unfold. We're watching history unfold now. Most of my clients are baby boomers. Most of my clients are retired or retiring or thinking about it. And we have very, very specific concerns. Most of us have done very, very well with our careers. We've made a lot of money. And our career has been the source of our income. And we've lived very, very well. But once you retire, that's over. So we have freedom, go have fun, but we need to be living on our investments for the most part, investments, Social Security, and some pensions. Social Security, in 2020, the average couple was around $2,300, $2,400. That's the average couple. Some of the higher net worth people will be doing better than that. But the average person is making $2,300, $2,400, so less than $30,000 a year from Social Security. So it's not very, very much. Now, in this environment, I have some real concerns. So if you follow my work on YouTube or you follow my work on the internet, you can go to my websites and follow some of my work. You know that I have some specific concerns. So let me go to the slide deck and we'll talk about what we're looking at right now, if we possibly can here. So now this is a slide I got from Zero Hedge. I think Zero Hedge is probably one of a really, really nice site for you to go get some economic material on what's going on in today's world. But a lot of my clients are baby boomers. They're in the bond market. They've done incredibly well for the last 35 years. Interest rates have been falling for the last 35 years. Now, as a baby boomer, I remember Paul Volcker, 1981, when he broke the back of inflation, because inflation was rampant from 1975 to 1978, 79, and then they started raising interest rates. You can see that here. This is a perfect example of the cycle right here. Now, you see that these cycles get mirrored elsewhere and that they aren't completely smooth, but the general trend is going up and then coming down. So on an interest rate cycle, it's a really, really long cycle. It's about 75 years. So for 35 and a half years or 37 and a half years, you saw interest rates rising, and they peaked with Paul Volcker in 1981 when he put the, I think he got the 90-day treasury was like 13 or 14%, just stopped inflation. And that was the end of the real estate cycle, of the interest rate cycle. And interest rates quit going up and they started coming back down. And for 35 years, 37 years, we've had interest rates coming down. And if 35 years to 1981 would take you right around 2016 was textbook, and we have a bottoming process. Now, this bottoming process is at a 5,000-year low. We're in LERP or NERP. So LERP is a low interest rate policy. That's what we have here in the United States. We have the central banks, we have the Federal Reserve, and we have the Treasury suppressing interest rates. So if you're a saver or you're a bond investor, your rates have just been suppressed, and we're down to almost next to nothing on the income. Now, you've done very, very well on capital gains because the price of these bonds has gone up significantly, but you don't have any usable income anymore. And we're down here at a 5,000-year low. When you're at a 5,000-year low, it means interest rates probably aren't going to go any lower. We're done. And if you just look at the cycle, you can see that the cycle is telling you that it's over with. That means that if you're a bond investor and interest rates start going up, you are going to start sustaining losses, because there's an inverse relationship. As interest rates go up, bond prices go down. And if you've got a bond portfolio and interest rates are going up 1, 2, or 3%, I mean, if we went from 0 to 3.5%, that would still be pretty good interest rates. 3.5% interest rates, that's pretty good. It'll devastate your bond portfolio, though. You know, on a percentage basis, we've just gone from 0.6 on a 10-year rate, less than 1%, 0.6% for 10 years. And now we're at 1.7, 1.6, bouncing around through there. So it's gone up on a percentage basis really, really high. You can go more than 1%, but on a percentage basis, it's incredible. And those holding bonds are going to start taking losses. So let me go to the next slide. And you can see the change in 1 quarter. Now you can see that interest rates right through here are taking losses. Last quarter, interest rates went up again. And it's one of the highest changes in yield ever in last quarter. This is a big change. If you're in bonds, you're going to take a loss. So you need to talk to your financial planner, talk to your financial advisor, certainly talk to your spouse, and find out what's going to happen. How is this going to affect your portfolio? How is this going to affect your retirement? And how are you going to take losses? Are you at risk? So you want to find out if this is something that you need to pay attention to. Now, here's the other thing. Again, another zero hedge chart, but this is from Bloomberg. They're talking about commodities, and again, a cycle. And we're talking about commodities going up. So not only do you have interest rates going up, we have inflation going up. Now you hear about this. Lumber has more than doubled in 1 year. Steel is up 65%. Copper's up. Aluminum is up. Oil's up big time. Coal, iron ore, all these products are going up. Now, this is base commodities. So could it go up to 5 or 6%? Well, sure, just look at the chart. Not unusual for it to be 5 or 6% anytime. Of course it can. And we've been enjoying benign inflation for the last 2 decades. You actually see it actually came down, where a lot of inflation was lower. You know, we're looking for the last 2 decades, 1.5% inflation, 2.5%. So for 20 years, we've had, 2% inflation. But inflation is insidious. You can't really see it, but it goes after your purchasing power. And here's what's bad for us as baby boomers. If you would have retired in 2000 with $100,000 of income coming in, you would have thought you are just sitting pretty. Lots of money. I'm going to be able to do all those things I want to do. Go have some fun. I'm in my early 60s and I'm going to go have a blast. Well, in benign inflation for 20 years, your purchasing power has been decreased by 40%. So that 100 grand you thought you had coming in is now 60,000. And let me tell you, a lot of people don't start at $100,000. As I mentioned before, in 2020, the average couple getting Social Security is like $2,300, $2,400 a month, less than $30,000 a year. And that's what they live on. How would you like to have that $30,000 a year cut by 40%? So now you're making $18,000 a year. And here's the problem. 20 years later, we're no longer working. We're in our mid 80s. Maybe we're in the 90s, and our purchasing power with benign inflation has been almost cut in half. What's going to happen when we look at this? What's going to happen when you start looking at inflation is running 4, 5, 6, 7%? Where your purchasing power is just going to get decimated. Do you want to be 90 years old and you're thinking that $100,000 is only going to give me 40,000, 30? What if you started with 60? So this is a problem. This is something you really need to talk to your financial advisors about. Talk about rising interest rates and rising inflation. A very, very bad combination for a baby boomer that's retired or retiring is something that really, really is a problem for us. You need to address it. It's not going to go away. This is something you really, really need to take care of. Now, you can see this in the price of homes. All you have to do is turn on any media, and everywhere across the country, prices of homes are going up. That's because lumber, drywall, aluminum, copper, oil are all going up. And these are the basic building blocks for single family homes. And across the country, that means in every small town that maybe doesn't get much appreciation, doesn't have much growth, the whole country, homes have gone up 11.2%. But if you'd have been in the great markets of the United States, like Florida, Texas, and Arizona, it's much higher than that. Here in Maricopa County, our entry-level homes went up 21% in 1 year. So if you're an entry level and you put 20% down and it went up 21%, you means you made over 100% on your money. Now, most entry levels, they're an FHA buyer or 3% down, 5% down. They maybe put, they buy a house for $250,000 and they maybe put 20 grand down. Price at home went up 25. So it's significantly more than most people. So they've done very, very well. So what I'm suggesting to you is that you start thinking that maybe you want to get in front of inflation. When we're in single family homes, not only do you get price increase and inflation adjusted, single family homes are one of the greatest assets for an inflation hedge there is. So not only are you going to go up with inflation, but if you're in one of the great markets of Florida, Texas, or Arizona, you get the organic growth that's going on in the markets. And here's the best part at all when you're a baby boomer is that we get income, really good income. And you don't have to be the landlord. Once you realize you don't have to be the landlord, you can buy the property anywhere you want. And I'm suggesting you buy it in one of the great markets of the country. Florida, Texas, or Arizona, let a property manager handle this for you. And that income will grow year after year after year. And it's not annually, semi-annually, quarterly. It comes in each and every month. Now, I'm not suggesting that you put all your money in real estate, but I'm suggesting that you talk to your financial advisor, find out if you're at jeopardy with your bonds, and maybe you need to start thinking of transferring some of your assets into the real estate asset class for yourself and protect your purchasing power. Now, this is the real estate cycle that we've talked about. You're welcome to follow me on YouTube, follow me in any of my work. We're here. This is the accumulation phase. We're going to go another 6 to 12 months. Then we're going to go into the explosive phase, and we're going here. Now, I know this is hard to imagine because prices have gone up so significantly across the country. But according to the cycle work we have, prices are going to go much, much higher. So if you've got a retirement account that you feel that maybe you'd like to get a boost into, if you haven't got anything in your retirement, if you're thinking of retiring, you've got an opportunity staring you in the face. Please talk to your financial advisor and see if this has worked for you. Now, this cycle has been very, very accurate. Doesn't mean it needs to completely stay accurate, but it has been very, very accurate. If you follow my work, you know, March 2018, we called to the month the fact that we're going to have a mid-cycle correction. We also called to the month that we were going to have it's going to stop in December, fourth quarter 2019. We're going to get a pop. And then we thought we have a really strong likelihood of having another mid-cycle correction, which would be buying opportunities. And here it is. This was January of 2021. We started coming down again. Who would have thought we'd have this collapse in the economy with this COVID thing? It wasn't on our charts. We just saw the fact that we had a correction. I had no idea why it was going to happen. We just knew that on our charts, it showed the fact that we were going to correct. And here again, we corrected very, very shortly. And real estate has done very, very well, just like the cycle has predicted. And it continues to predict it. And according to the cycle, you've got this accumulation phase where you can buy some properties. And we think that prices are going to become significantly higher, particularly if you're in the great markets of the United States, Florida, Texas, and Arizona. And within those great markets, there's really big sub-markets that are just doing outstanding. Here in Maricopa County, which is home to Scottsdale, Peoria, the number one zip code in America, Gilbert, Arizona is in Maricopa County. This county is just doing incredible. And it'd probably be a great place for you to consider parking some of your investable dollars. You don't have to put all of it here, but this might be a very, very good idea for you to do that. Now, I'm going to be a little mercenary here. You're welcome to read my book, How to Create a Real Estate Money Machine and Retire with Income. This is my business plan. I wrote it. I used it. I've been semi-retired since 1991. My life has been absolutely incredible. I have another book coming out next week, Real Estate Investing for Beginners. You're welcome to look at that too and see if that's something that would work for you. And you're always welcome to reach me. I'm here to help you. We have a great staff. We're very, very good at what we do. You can reach me at michael@michaeldouville.com. I'm in a corporate office here, 602-942-4200. If you need me, we're more than happy to brainstorm what's best for you. We'll talk to your financial planner. We'll talk to your CPA. We'll certainly talk to your spouse. We'll brainstorm. We've done this for a very, very long time. We're really good at what we do. If I can help in any way, let me know. My very, very best to you. Bye-bye now.